Hey everyone, Logan Hertz here with Hasseltine LLC. Today we're excited to have with us Tyler Wille of Life 180. Tyler is one of the partners at Life 180 who works with Chris Kirkpatrick, who we've also had on our show. And he's been in the business for a lot longer than me. And he has been in the business long enough to have some real results to show. And we're going to go through a few of those today because one of the things I always like to emphasize is that the plans that we typically put together have results that are guaranteed. We're not hoping on some market index, hoping on various external factors that we have no control over. And so we're going to talk through a few of the ways in which Tyler's clients have used some of the plans that we put together in order to optimize their financial strategy. So Tyler, great to have you on the program. How you doing today?
Doing great. Happy to be here.
So why don't you give us a quick introduction to you and then maybe we can jump into some of the success that your clients have been having.
Yeah, so I walked into the business on accident out of college, and I actually got hired by AIG, who's now Corebridge. And I went through their whole training program, which lasted about 6 weeks. And then they terminated all of their career agents and basically let go of everybody. And
Wow.
then I just happened to know somebody that worked at Mass Mutual, a friend of mine, and joined Mass Mutual and went through their whole thing. And I was there for 5 years before I met Chris, and then came a partner with Life 180 and went out on my own. Lucked into it, always knew I would be in the finance sales space. But yeah, so that's the overview. I got just had my first daughter, so 1 year old now. So I feel
You feel
definitely
old?
yeah, definitely, I start to feel old for sure, but
One yeah, one of these days we can talk through your experience going through the industry. That'll be really interesting, but probably not too it'll be interesting to me, maybe not as interesting to our audience, but I'd love to hear all about I'm sure you got lots of war stories from your time going through the industry.
yeah. Yeah, definitely, it was a different age. I was in the transition of when, it used to be this very rigid program, and when the internet came out with YouTube and all these things started to change, everything started shifting, and I was there during that in between, so it was chaotic for sure.
Yeah, interesting. That was before my time, so before I joined anyway, before I became a member of the industry, as they say. So yeah, I know you've got some success stories you wanted to share with us. So we picked out a couple. You want to walk us through? Maybe start with I think it was your mom was one of your clients.
Yeah, so I think the first one, people tend to show these crazy buying buildings and leasing those and all. And while that works, I think what most people tend to use first is what I call like the stepping stones of what I would say large purchases, right? And the most common large purchase that I see is cars, right? Or any type of thing. So I've done several comparisons and I'm happy to pull that up of what it's like to pay cash for your car, what it's like to pay lease from the dealership or the bank versus if you have the money in your whole life policy financing it through your policy. My parents are clients of mine, and about 2 years ago, coming up on 2 years, they financed their Tesla with their policy, and so I've seen it work, firsthand. It's more efficient than using all of your savings if your bank car is cash, and so
Mhm.
on and so forth. And so I have it up on the screen, but I think before we cover that, I think it's important to see like at least the framework of
Yeah, yeah,
why it works. The baseline of like the way that I describe why it's so efficient is if you have
and what we're talking about here is using a specially designed whole life insurance policy to finance something, and that something depends on you. It's whatever
correct,
you were going to buy anyway. In this case, it's a car, right? So
correct.
we're not talking about an investing strategy. That's not what this is. We're talking about a more efficient way of financing large purchases.
Yeah, just to rattle off the number one that I see is the car, right? I used my personal whole life more recently for my new roof, right? Roof or home improvement, right? Is a common one that I see a lot of the time. Unexpected medical expense,
That's a big one.
or what I call a high credit card debt kind of situation where you have to put it on a credit card, but then you come back and you use your whole life to pay off that debt. So it's
Right.
really a good foundation to fall back on so you don't get
Yes.
yourself into a hole. So,
Yeah. And that is what we call the debt recapture strategy, where if you have debt and you just pay it off, the problem is the money you're using to pay off that debt is now gone, right? You pay off the debt, that's great, but all the money you used to pay off the debt is now gone. If you instead take that money you're going to use to pay off the debt and flow it through your whole life policy first, and then borrow against your whole life policy with a policy loan and pay off the debt. Now you've got the paid off debt, and yet you still have the money that you used to pay off the debt because it's still in your whole life policy safely earning for you. And that's why
exactly.
recapturing debt inside of your banking system, inside your whole life policy, can be a better way of paying off debt. So you get the best of both worlds. You have a paid off debt and you still have access to the capital you used to pay off the debt and it's still earning for you.
Exactly. So, in this example, just before I dive into the actual illustration of why it works so well, is if you have $100,000 loan, right, or $100,000 in cash value inside your policy, and you take a example $50,000 loan to for your Tesla, right?
Mhm.
In this
Mhm.
case, you still have $50,000 over here that you didn't borrow.
Correct.
And
Mhm.
so let's just assume for easy math that the dividend is around 6%, okay, which would be a positive $3,000 over here.
Mhm.
Okay. Now, over here, right, this loan might be costing you, I'm going to say 5% for easy math. And so that's minus 2,500. But the
Mhm.
power of this, and I don't know if you've gone through this on your channel, but the company's still going to pay you dividends on this chunk of money right here. And so you're
Right.
still going to get around this plus $3,000 in dividends, putting you
Right.
at
You are being paid dividends on the full $100,000 principal balance because no money left your policy, right? No
correct.
money left your policy.
And so this right here, we would call that a positive spread, which right now with this high interest rate environment doesn't isn't exact numbers, right? It's closer to a zero on this side, right? But that's only if you're not paying this interest payment right here. So
Right.
they if you're being a responsible banker, like in this case, like purchasing a car, you would want to continue making a payment, like you would be replenishing your savings account or paying off a bank loan or the dealership, right? So you're used to making payments. And so when you start actually making payments on this is a simple interest calculated. It's one of the most efficient loans that you can get, and it's unstructured.
So when Tyler says it's unstructured, that's a good word. Basically, that means you're your own banker. You decide how you want to pay it back. It's totally up to you. The insurance company is not putting any required repayments on you because they know the death benefit will pay off that loan when you die if you never pay anything back. So, with great power comes great responsibility. You don't have to make any payments. And depending on what you're using it for, it might not make sense to make any payments. But typically, we want to play honest banker with ourselves. And we would look at what would a $50,000 loan cost in the market, and we'll pay ourselves now that market rate. And that money that we're using to repay the loan just goes back to recapitalize our own policy. It doesn't go to a third party lender, it goes back to us.
Absolutely. So I'll share my screen here and show. So this, for this specific example, it's the loan's about 2 years old. They've been putting a lot of money towards paying back the loan. It's actually this policy is 9 years old. So you can see right here, we're in year nine. Okay. This is a 10 pay, meaning that this is a policy that they only pay for 10 years. And then it's what we call paid up, meaning no more cost of insurance. It's guaranteed no more payments. And so you can actually see, so we're in year nine, and then in year 10, you can see that this is showing 17,000. What this was it was a $12,000 a year annual premium for 10 years. This extra 5, which is bringing it to 17, is this loan that they're paying. Okay, so he's putting $5,000 a year, which, think of it this way, is 500 divided, or 5,000 divided by 12 is less than $425 a month, right? So that's what he's paying towards this loan to pay it off, and it will be paid off in 3 more years, right? So I basically structured it to be like a 5-year car note where they did, and then I did a little bit more custom because the first year they put more like they sold their old car, right? So they got money, so I applied that and so on and so forth. And so then I just reverse engineered it to be, hey, it's $400 a month. And so when you look at, that from a, okay, I'm financing my Tesla for $400. Number one, it's was cheaper than going to the bank
Mhm.
for the dealership. And then you've been talking about that recapturing of those dollars
Mhm.
is invaluable, right? And
Yeah.
so you can see,
Complete and total control the whole way through, right? There's nobody else dictating the terms to you. You have total control. If you need to pause payments, no big deal. No one's going to come and repossess your car because you missed a few months of payments because you had some unexpected expenses. And I want to point out the level of service that Tyler is providing to his clients. This is something that people in this space, like Tyler and myself, do that unfortunately your typical financial professional is not going to do. Right. If you go to your typical financial professional and say, "Hey, I want to take out a loan against my policy. I'd like you to help me structure that loan and a repayment schedule." You're not talking about something that has nothing whatsoever to do with life insurance, right? You're talking about financial principles, you're talking about financing, and that is where people like Tyler and myself can help you in a way that your average financial professional wouldn't even know how to do. So think about the level of service that Tyler is giving his clients. You won't, that's not typical in the financial industry, folks. That's not typical, just so we're clear. So he helped the client figure out, okay, I'm going to use my policy to finance my car. What does that look like? How do we set it up in the most efficient manner? Right.
yeah. And then I think another good thing that even is how fast, what does this process look like? Because a lot of people think it's very confusing, but
Can you
it's
full
really,
screen that? Can you full screen that, Tyler?
so a lot of people are, oh, this sounds like a really complicated process. It's not, right? For this past one, because I'm familiar, obviously they're my parents, so it's a little easier. But
Also, one more thing, sorry to interrupt, but I
yeah,
want to point out too is that from the perspective of the Tesla dealer, you're paying cash when you use a policy loan, which
correct.
means you will get a better price, right?
Yeah,
Um,
so not only that, so this is a little extra layer. So Saturday night, 2 years ago, I knew my mom was shopping for a car, and she goes, "Okay, I made a decision. I'm gonna buy a Tesla." Okay, so you can do this online, right? Or you call, you go online to the portal that you have, or in her case, she called me and I did it for her, right? Or Logan, and you submit a loan request. Okay, for whatever she wasn't quite sure. She knew she was in the final stages of the negotiation. We did this Saturday night. Monday morning, because she did direct deposit, 50,000 was in her account from the loan from the policy.
wow.
Okay.
Wow.
Now this is cash, right? So the dealership doesn't
So
know where.
so that loan request was to the insurance company.
Correct. Yes.
So
And so then we have, okay. Then what I told her was I said, hey, in order to get like the best book, tell the dealership we're paying cash, get the cash price,
yeah,
which
and Tyler, was there any credit check on that loan request?
no credit check because she said she was going to pay cash. And then on the next level, just to get a little extra, when she finally got the cash price, she said, how much can I put on my credit card? And
Mhm.
so she has like a 30, they took about 30,000. They said, oh, we'll do 30,000 anymore. They gave some
Oh, that's
excuse.
awesome.
And so she got $30,000 of the credit card points.
There you go.
And
Yep.
so the rest she paid cash from the 20K. And then she immediately paid off that credit card with the loan.
And it
Right.
kept
So
the points that she earned. Yep, that's smart.
all of this was she went to the dealership on Wednesday. Right. There was a little bit extra. We repaid a portion of the loan that was unused. and that was the end of it. And then we actually waited uh, almost 3 months to actually start okay, we're going to start making this payment plan, right? So we let everything settle for a couple months just because it's ease while you're getting used to everything. And then we set up this kind of repayment plan. So it's not a complicated process. I have some clients that do it themselves because they're just the do it yourselfers. And I have
Mhm.
other clients that call me and they say, "Hey, help me out." So I want people to understand that it's not that confusing of a process, especially after you've done it
No.
once or one time.
Yep. You can go to the online portal and request it. But of course, Tyler and I are here to help you. I similarly have some clients do them themselves. Some prefer to work through me. Either way is fine. I'm here to help you every step of the way. So is Tyler. And not only are we're not just an order taker. We're not just like, how much loan do you want? When do you want? No, it's okay, what are we using this loan for? Now let me help you think about how are we going to take out the loan and how are we going to pay it back? Right. What makes the
Mhm.
most sense? Right.
Exactly. If we look at this illustration he's done in 3 years now that they're gonna be using this policy as a retirement buffer, which we could go down that rabbit hole because they basically each have one of these identically, so they're this times 2, and so this is their buffer strategy in retirement, but it's also their any large purchases. They're gonna have to do some hurricane windows since we're down here in Florida, they'll use this. They'll everything that they'll need over their course of retirement, this is gonna be their buffer tool. So assuming in 5 to 7 years, there'll be another car. And so that the process just rinses and repeats. And you can see cash value continues to grow, death benefit continues to grow. And so if they need some long term care at the end of their plan, there's a few 100,000 in here that they can tap into without impacting any of their other assets. Right.
And so you can see here we're in year 10 or year 9 currently.
hmm
Um, and those that $17,000 outlay, is that the premium minus loan repayments?
Yeah, so it's both the premium plus the loan, right?
Got it.
So that's
Okay.
why in year 12, there's no longer it's not 5,000 that's needed to pay off the loan. There's only
Right.
4,182 and the loan will be. And you can see they give you different loan rates of like different examples. So the
Mhm.
cap is 8%, but you can see how it doesn't really impact even if loan rates increased by 1%, which would be a massive increase from a percentage standpoint, it doesn't really change the net out of pocket by
Right.
only 100 and something dollars in that
This is because this is simple interest for a
correct.
year. It would compound if you made no payments over the course of that year. But if you at least paid the interest, then it doesn't compound. It's just simple interest. But you're in complete control. I think the numbers are great. I love showing numbers so people can see how it puts you in a better position. But I think one of the things that you'll see is that, especially if you're working with real estate investors, they're okay giving up some yield and getting maybe a lower dollar amount because they have more control when they use their policy. And every real estate investor's got some negative story with a bank that happened, or a bank pulled the plug or did something that he didn't like, and they would just rather have control. And they're okay, maybe paying more in interest costs if it means they have more control. Now, maybe for
Yeah,
something like a consumer purchase like this, maybe that's not as important, but it's not just the fact that you end up with more cash in the pocket. It's not just the fact that you pay less in interest and you have all that capital back in your policy after you've bought the car. It's also the fact that you have total control from start to finish of the process. You didn't have to go and ask permission from a bank. You didn't have to give up any of your own capital. You didn't have to get a credit check. And the repayment schedule is now completely and totally up to you.
absolutely. And when you compare those out to what you would have in your savings account, that interrupted compounded growth causes a huge if you're looking at it on a 1 or 2 year basis, probably not. But if you are
Right.
cycling this policy several times throughout your entire lifetime, I have a policy on my daughter Layla. And the numbers
Awesome.
that I look at that are 30, 50 years out of it, even if all she ever did was buy cars every 7 years, is a staggering difference. So
Mhm.
it's definitely a long-term beneficial play.
Absolutely. And it's long term, but it also makes sense in the near term because you have that death benefit because it's a self completing plan. So
Mhm.
if you started some kind of a plan like this that was not, let's just say it wasn't life insurance, but somehow you could do a similar plan. I don't know how you could, but and then you drop dead tomorrow, now your plan is interrupted. Right now, it's not going to happen. Right now, someone else has to figure out what to do. But because we have
Yeah.
that permanent death benefit, we know we are going to reach that level, and the plan is going to complete. And the cash value increases every year. So does the death benefit.
Yeah,
So
absolutely.
no matter what, we're coming out ahead. So some when they say this is a long term strategy, I agree, but it's not like it doesn't make sense in year one once you include the death benefit in the calculation, then it does make sense year one, right?
Oh, there's tons of reason why it makes sense in year 1 besides just compare like you said, many people are saying, "Okay, I'm a little bit behind in year 1, but I'm picking up all these other benefits." And there's
Right.
a lot of benefits to it.
Right.
And so it's important to understand those, but the value is certainly there. And so I have people that use it. So I like to talk through like real. I have a couple clients that use their policies now for long-term care. I have clients that use it to finance their vacations every year. So I have one retirement couple that they take 30,000 a year out, right? And between their pension and social security and all these other things, they say, okay, they can, by paying cash and not financing they're hitting their bucket list. They take 30 grand, they pay everything off. They do the credit card method, so they get all the points for all the
Mhm,
travel.
mhm,
Then they pay the credit card off with the whole life policy. And then they set up okay, we're gonna put in $2,000 a month to pay that off before the next year, and then boom, they rinse and repeat. So every year they're taking 2 to 3 really nice vacations. So I see that as people have used it for that, the long-term care, the cars, the real.
now, when you say long-term care, are you talking about people taking out a policy loan? Or are you talking about them actually using the chronic illness rider and advancing themselves the death benefit?
So that's a relatively new rider. My mentors, they're 30 years in the business, which those riders didn't exist more than 5, 10 years ago.
Okay.
And my only issue with those riders is they're excellent. I have 6 out of my 8 grandparents between my side and wife's side what could have qualified for long-term care from dementia, so
Mhm,
a chronic illness,
mhm.
but it doesn't cover non-chronic illness things of like just getting old and just
Right,
being frail.
right,
But the
right.
cash value, you don't have to be approved for anything. It's your cash. At least in that one that I was showing where, the cash value at age 85 is 300 grand. Obviously, my parents want to leave that as a legacy. Obviously, that's their primary goal. But if if something happens, I'm gonna say, yeah, here's 50 grand, pay for a caretaker or whatever I have to do. Like I know that money is there, and then you have all the tax benefits. I don't have to sell something in their portfolio. I don't have to sell all those other things to get them the care that they need. And this policy does not have that chronic care. So even 9 years ago, that really wasn't a thing. And I didn't really know about it. It just started becoming more of a thing recently. So yeah, the industry's always changing in that regard.
Yeah. So what Tyler is talking about is now most of the whole life policies that Tyler and I sell come standard with what's called it. It depends on the company. They all have different names for it, but a chronic illness rider, where basically, if you have some form of long term care need, you can actually start advancing yourself the death benefit, not just the cash value, the death benefit to pay for those long term care needs. And of course, we would look at that because we want to make sure that it makes sense, but it's a great option to have because most people, unfortunately, have no options when it comes to dealing with long term care. And they have to do a lot of what you suggest. They have to start liquidating assets to pay for long
Mhm.
term care, and then they run out of assets. Long term care can be pretty expensive. And the other nice thing about the chronic illness rider is the flexibility. So it's not reimbursement based, which means once you meet the requirements, which means unable to perform 2 out of the 6 activities of daily living or having some cognitive impairment like Alzheimer or dementia, you can start using that rider. You don't have to incur any expenses. It's totally flexible in terms of how you spend it. So you might be spending it to make upgrades to your house to get it to make it easier for you to get around your house, as an example, right?
Yep.
Install an elevator in your house because maybe you have trouble getting up the stairs, right? Put a bar in your shower so you can lean on it, things like that, right? So you
Yep.
don't have to submit a receipt to the insurance company, have them reimburse you. You can spend it however you want.
Absolutely. So those are people always are like, oh, well, how am I going to use this? That those are just out of the box ideas that I see people use it all the time. Then you have the real estate world, which is where they're
Yes.
leveraging it and becoming their own bank. But I also want people to realize that you don't have to be a real estate investor to take value in these. You can use them
Right.
for all of these unexpected life bills and things that come your way. And so I think that's important for people to make sure that they understand.
The more I go in this business, the more I realize you don't have to oversell it. Just standard whole life insurance structured well as a savings account on steroids with leverage death benefit in the policy loan. That's already phenomenal. People already want that. You don't have to get into more fancy stuff.
Yeah. No, you definitely do not. So I know, do you want me to talk about that
Yes,
one
please
real?
do.
Okay.
Speaking of more fancy stuff, now let's get to
So
some more
so
advanced use cases.
yeah, so I have a client that and the illustration is very confusing because obviously his situation is a little more confusing, but if you like the idea of one day being able to leverage this policy for purchasing real estate, here's a real case example. It's not as old. The policy is not as old as the 9-year-old one, but um,
Yeah, Tyler, I'm disappointed you didn't just buy your mother the car. What's wrong with you, man? What kind of a son are you?
eh, I got there's other things that I'm working on. So
You provided her with
these,
grandchildren. That's way more
yeah,
important.
yeah, exactly. So we have so this guy sold his business, his first business. He actually front loaded this policy with $650,000. Okay. Now he had year one 90%. So you always have around 90% liquidity year one. That's about as max efficient, maybe slightly more. But the reason for that is if you don't pay the loan off, there's enough cash to cover that loan. So he had access within about 30 days to $585,000 of cash value. Okay. Now he already knew what he was going to use this cash value for. So he, and I'm going to draw it out so people get the good visual because I actually went out and visited him. So there was an intersection where they had one office building here, one office building here. I forget the grocery name, but down here it was like the big grocery store, right? Big Publix L-shaped plaza here, and over here was so these were medical buildings. And I'm not familiar with this was in Arizona, so I'm not like familiar with the city and things like that. But then there was another kind of big strip mall here. So this property was listed for 500 grand. And this was 4 years ago. So this was like during COVID. He was, and the reason why it was listed so low was whoever had these messed up the lease rates. So the lease rates were 25% less than what they should have been. Okay. And so there was 4 years left on that lease. So he couldn't change anything. So it was a losing proposition for him for 4 years. And he
Mhm,
understood that going in. But he
mhm,
knew that as soon as that 4 years was up, he could match these lease rates over here.
mhm, mhm.
Okay. And so he knew that it was going to be a 25% cut from a cash flow standpoint.
Now, I just want to point out this is the sort of analysis people don't seem to do when it comes to whole life insurance. They gasp in shock at the loss of cash value, the loss of liquidity in year one. But it's, hey, this is how anything works. This is just economics. You can't just put money into something and immediately have it spit a bunch of money back out to you. It takes time. That's not the way it works, right? So, this is similar to a whole life policy. You got to wait 4 years before you're going to actually get cash flow positive, right?
Yeah. And to go to a bank, if he were to do, so he looked at a traditional financing method, right? He looked
Mhm.
at the interest only was not very attractive because of the down deposit, it required a large down payment.
Got it.
And so those two were like the more traditional methods. And so he said, okay, what if over here he knew that he could get a 5% simple interest and he said, okay, I can finance this myself. All I have to do is wait 4 years and I know that this thing is going to increase crazy from a cash flow standpoint. And so this whole deal made sense was it was ended up being he took 50,000, it was like 600,000, so he took 100K cash, 500K from the policy, and the only reason why I told him to do that was just easy to keep track, right, from a loan
Mhm.
standpoint. 500,000 times 5%. So he knew that all I had to do from a mortgage financing method is that's
Right.
my required payment. Now he didn't have to. We talk about being unstructured, like he could have had the dividends and the premiums and the leftover cash kind of pay that interest. But I said, hey, it's really best practice to pay at least this interest only. And he said, I can afford that. That's fine.
Mhm.
So he's been paying that for 3 years now. And yes, so that was the first 2 years was a 5% interest, right? During COVID. Then we had a slight interest rate increase to 5.5. So it went to 27.5. And now we're in year 4. So he's in the process right now of renegotiating all these leases. Now, kind of cat's out of the bag where somebody's coming in and offering him 1.2 million for it. So I
Wow.
think he's going to sell and take his
You see what having
money.
access to capital in a whole life policy does for you? These are opportunities you don't have if you don't have cash in a whole life policy that you can deploy, right?
Exactly. But I do know that his rent is, and I don't know the exact numbers. He just comes to me with, "Hey, this is what it would be." Thing. I don't look at I'm always happy to look at, like, the real estate reports, but this guy's more of a do-it-yourselfer. Um, but the rent is gonna go to around 22,000 a month, 22K a month.
Is that total for everyone?
Yeah,
Okay.
and that's after.
So that's net
Yeah, it's
income
a
to
trip
him.
they're doing, like, a triple net lease, so that all the
Okay.
tenants pay all the other stuff.
Got it.
So that would the only thing that he would be responsible for would be the whatever fine if he keeps paying this whole loan back or goes to a
Mm.
traditional mortgage now. But before that, he was at 14 a month.
Wow.
And so that's why between it was a little bit certainly a little bit more it was still profitable, but this was supplementing his income for because he had just sold his business. So he's re getting back out there. So this is a real life example of how having access to that cash can put you in a better place.
And it not only gave him the capital, it gave him the time too, so that he could afford to wait those years so that the investment became a winning proposition. And just to annualize that $22,000 a month comes to $264,000 in annual. income, and that's net. That's after all expenses and everything. The only I guess the only cost not included would be the interest costs on the loan, which you would have, right? Which
Yeah,
which you
I'm
can
sure
manage yourself too.
I'm sure there's a couple other expenses in there too, but that's like that's what those are the numbers he gave me. So that's all I can go off. But
Abs
it's a big difference. He was in the position to go in within 3 days. I remember he came in, he said, "I think I'm gonna pull the trigger." He asked for the loan on a Monday. Funds came in on a Friday. He closed the following Tuesday. So it was all within a week.
that's phenomenal. That's phenomenal.
So
I'm thinking I have
didn't have to go get pre-approved, didn't have to go do anything. Now he had talked about right afterwards going and then going and getting it financed on the traditional method. But as soon as those 2 came back with the mortgage was extraordinarily high.
Mhm.
The interest only at the time was like 8% because of the equity of the property.
Yeah.
He was saving 3% by using his whole life, but the if that ever came down, he could switch. If it ever went back to
Exactly.
3%,
Yeah, that's a great point because you're not locked in. If you use your whole life policy, you can still go back and refinance into conventional financing at some point if you want to. It's totally up to you. Of course, you'd have to qualify. That decision is not set in stone. You always have the option to buy a property for cash using your whole life policy loan. You can later do a cash out refi on that property. You can refinance later. You can still use those other lenders if you want to. And now you're in control because you have another option. And again, to your point, when you have the capital in your whole life policy, you can get better deals because you can close a lot more quickly and you're coming in as a cash buyer. Right? And so it's not even an apples to apples comparison because when people try to compare using a whole life policy loan versus conventional financing versus paying cash, they're assuming the price is going to be the same across the board. But probably the price won't be the same. It'll probably be cheaper if you're coming in as a cash buyer, and you'll probably get deals you couldn't otherwise get because you can close so quickly. You don't have to wait for financing contingency, right?
yeah, absolutely. And you don't have to go this large scale either. I have clients that they go to the bank and it helps them get approved because they say, okay, on a $200,000 house, I'm going to come up with a 50% deposit. Right. So the bank says, oh, okay, the approval process is much faster because you're not getting a 95% loan or 80% loan. You're say, hey, out of this 200 grand, I'm coming up with 100 myself. Here's the cash. Here's the statement. Here's where it's coming from. And they classify that as net worth. It's a tier one asset. It's very easy to do that. That's what my father did for a long time was like fix and flips. And if he couldn't pay cash for them, it would help him get financing much quicker.
Yeah,
So,
I had a client go through that recently. The first thing she did was with her whole life policy, she took out a policy loan and paid off all her credit cards. I want to say it was like $50,000 balance. So she paid off her credit cards with a policy loan. And then those payments that she was making on her credit cards, she started making back towards the policy loan. So she just redirected all the cash flow that was going away from her two credit cards back to herself into her own policy. She recaptured all that debt. Then after she paid that off, she used a policy loan to do a down payment on a vacation rental property. So she's still getting conventional financing, but she's using a whole life policy loan for the down payment, right? So you can, to your point, you can use a combination of the two. It doesn't have to be just one or the other, right?
yeah, and banks don't take that. If I loan money for my whole life policy, they don't take that as a debt. They take that,
No,
okay, as
no,
you have cash, and
cash,
here's the
right?
cash, and that can be applied. So the purpose is that you could be really big. I know some hedge fund guys that have basically COLI with corporate owned life insurance, and they're doing massive amounts of money into their whole life policies. And I know people that are doing vacations every year with their whole life policy to help finance it rather than put it on credit cards at 18%. So there's a range of uses for these policies. And
Yep,
the longer you
absolutely.
have them, the better they get.
Absolutely,
So,
absolutely. That was awesome, Tyler. Thanks for sharing a couple of these success stories. Hopefully, we can do some more later on with actual numbers. That was great to see. So, we've seen a simple use it to pay a car. And if you're not buying a $50,000 car, it could be a $10,000 car, whatever, right?
Mhm.
Same logic applies versus using it to make a very large purchase on an investment real estate property, but it's the same basic concepts behind it.
Yeah, I'll pull a couple policies that are 15, 20 years old from some of my mentors that the problem is it's hard to like when you look at numbers, it's hard when especially when in the real estate world and the business owner world when they use these cash to as I have some businesses that they use it as their operating kind of expense for their business on an annual basis. And so when you look at the loan, you're like, "Oh, wow, it's really high," but it's there's so much flow that it's hard to like really get an idea whereas versus okay, this person bought a house, here's what they're getting from it, here's this. So it's, I'll have to dig and locate some of those really specific examples uh, that we can check the numbers.
Because we're just looking at a snapshot when we look at an illustration. Yeah, I like the word you use there, flow, because this is about improving your cash flow too. So by this business, as an example, flowing their operating expenses through their whole life policy, they can recapture all of those expenses over the years. Where otherwise, if they just those operating expenses would have just left their economy, right?
Yeah, I have guys that finance their machinery through their whole life. I got some farmers that buy their equipment through them now. And it takes time, right? I'm not saying it's not a if you're in a blessed place where you can front load the policy like this guy, but most of these guys took 15, 20 years when they were and over time they've built up this pool and I got one guy, he buys semis, and it's if you buy a semi, he told me it's somewhere between 14 around 14 to 15%. It's not like your traditional auto loan.
Wow.
It's he's man, this every time I buy a semi and he leases semis, it's his business. Every time I buy a semi, I can loan it to these guys at 15 to 18%, and I get it at 5 from myself. And but it's so the flow is not the same, right? Because it's like they pay they're late on a payment. This happens, that happens. So it's just one of those forever adjusting number.
Yeah. Yeah. That was awesome, Tyler. Really appreciate you walking us through those examples. It sounds like you've done a lot of really good business over the past few years. Is there anything you want to leave our audience with in closing on these couple of examples?
Yeah, don't buy an IUL. That's my only take. I don't any whole life company from any insurance, any when you buy these policies, you want to buy from a mutual insurance company. You can't go wrong with any of the big major mutuals, in my opinion. It's better, but stay away from complex universal life products where you can't see all the mechanisms that work. So that's my only advice. So hopefully you choose Logan to help you with that. I mean, he'll back me up there, but and if you have an IUL, get it audited because I see a nightmare of these cases where people think
Yeah,
they can do all of these things, but then one thing goes wrong and it all falls apart.
right. Yeah. If you have, that's a good point. If you have policies, even whole life policies, we'll take a look at them just so you know what you have. I do that a lot too I have partners that I use who will look at like disability policies. If you have a disability policy through your employer, a lot of people don't even know what they have. You can get it from your HR department will help you at least understand what you have. And I think with universal life, a lot of people don't understand all of the moving parts in that policy. And at the very least, if you have one, we can help you understand better how it works and all the mechanics behind it. And if you still want to keep it, okay, but at least you'll have a better understanding of what's going on, right?
Yeah, I think I've audited. I'm starting to keep a tracker of how many of them I've audited, and I have yet to see one that will work for everything we talked about today. If it's just for death benefit for end of life, they can work. But somebody prove me wrong. I'm waiting.
Yeah. And my thing, I don't want to go down the rabbit hole in IUL, but
Yeah.
my question has always been the reason why I haven't really gone deep into the rabbit hole with IUL is because for me, it's always just a philosophical question. Look, if you believe in quote unquote the market, the S&P 500, then go and play the market. The whole
Yeah.
point of the infinite banking concept and full life insurance, the sort of strategies I propose is to have capital somewhere that's removed from all of that risk, right?
100%. 100%. I
So
couldn't
if
agree
you
more.
want to go and play the market, I'm not saying you can't do
Just
that.
go play the market.
Yeah,
Yeah.
you can do that. If you want to take on that risk, you can do that, but that's not the purpose of this strategy. So to me, it's a non-starter. It's like, why would you go to all the trouble of going through a life insurance application and putting a large amount of capital in this other place to then turn right around and hand the reins back over to Wall Street because we're going to tie our cash value growth to the S&P 500? I don't understand that. I really don't.
Yeah.
And I didn't get into any of the mechanics of universal life and how it works. To me, it's just a philosophical question. I'm not even calling it an objection. It's just a question, right? So,
Yeah. People get sold on the tax benefits, but
mm.
it's very misrepresented. So, but we can certainly do a video of that. I'm building out an IUL analyzer soft comparison tool with Tom Wall
Okay.
for March for he's doing an event down here, and he's
It's
like,
funny. Maybe this is just me, but I actually come across more VUL than IUL. I think that's just me. I don't think that's the market in general. Maybe it's just the luck of the draw. But
yeah, so that means you're coming across people that are securities licensed. And so most of the security brokers nowadays will not let, if you're securities licensed, meaning assets under management, money managers, you actually can't, most of them don't allow you to sell IULs.
yeah.
So if you're with a Morgan Stanley or Merrill Lynch or somebody, they can sell their VUL products, right? Because the variable is for market, meaning you can own mutual funds and things like that inside of them. But the IULs, there's too much risk, and so the broker dealers, Morgan Stanley, Merrill, you name them, JP Morgan, they don't want that potential backlash, right? So that's why they push the VULs. But they're actually the same ability now inside of the VULs with the S&P index inside of a VUL chassis. So it's very interesting that the industry is already starting to change from that standpoint because I think people are starting to wake up a little bit. We'll see.
Tyler, thanks so much for your time. We greatly appreciate it. Hopefully, this will be the first of many. I love going through real life success stories so we can show people that this actually works. It's been proven for many decades. It's not hypothetical. It works and it is working for
Yeah,
Tyler
what
clients.
I think I'll show is on our next one, I'll find one of the business owners that are using it as like their operating budget that has older than 10 years. And then I'll show, unfortunately, I can't, my daughter's is only 1 year old, but my other business partner, Dan, his daughter's 15 and her policy is 15 years old. So he has
Oh,
one that's 15 years old and he just used it the exact way that I'm planning to use it. He financed her car. She just turned 16 in June. So
parents, grandparents, you should be doing this for your children. And the beautiful thing is, time heals all wounds, especially in whole life. So you don't have to put a lot of money into it because that
yeah,
policy is going to be enforced for 80 years. Think about compound interest over 80 years. You don't have to fund it with a lot of money, but start it now. Time is the key component. Start it as on a newborn. That's the best
yeah.
time to start a policy.
So I'll show you my analysis for what, knock on wood, I do everything right, raising Layla, but everything that if all she ever uses it for is these three things, down payment on a house and her cars, nothing else, the position that she's in when she's 65, you're like, holy cow. Unfortunately,
How
I can't.
much how much
Yeah,
do you love your children and your grandchildren? That's evidenced by how much in whole life insurance you have on them.
yeah, yeah, that's true.
Starting
But
with yourself first, of course. Start with a parent first.
yeah, yeah, definitely on yourself. But yeah, so we can do that next time for sure.
Awesome. Thanks so much for your time, Tyler. Greatly appreciate it. Thanks. Bye bye.